Imagine if you could learn the exact investing strategy used by one of the greatest investors of all time. A strategy so powerful that it helped shape the thinking of legendary investor Warren Buffett. What if I told you that the secret to long-term wealth isn't luck, stock tips, or timing the market, but a simple mindset that anyone can learn? In today's video, we're going to break down the timeless lessons from one of the most important investing books ever written, The Intelligent Investor. By the end of this video, you'll understand how smart investors think, how to avoid costly mistakes, and how to build wealth patiently over time. Welcome to Money Library, where we turn powerful books into practical knowledge you can use in your financial journey. The Intelligent Investor was written by Benjamin Graham, often called the father of value investing. First published in 1949, the book has guided investors for decades and remains one of the most recommended books about investing. But this book is not about getting rich quickly. Instead, it teaches how to protect your money, avoid emotional decisions, and invest wisely for the long term. Graham believed that successful investing is not about intelligence or complicated strategies. It's about discipline, patience, and the right mindset. The central idea of the book is simple. An intelligent investor is someone who manages risk and controls their emotions rather than chasing profits blindly. Let's explore the most important lessons from the book. Lesson 1. Investor versus speculator. The first and most important concept in the book is the difference between investing and speculation. According to Graham, an investor carefully analyzes a company, focuses on long-term growth, and prioritizes safety of capital. A speculator, on the other hand, tries to profit from short-term price movements and market hype. Speculators often buy stocks based on rumors, trends, or quick profits. Investors buy businesses based on their true value. Graham warns that speculation can sometimes feel exciting and profitable in the short term, but it is extremely risky. Many people believe they are investing when they are actually speculating. The intelligent investor clearly understands the difference. Lesson 2. The market is emotional. One of the most famous ideas in the book is the concept of Mr. Market. Graham asks us to imagine the stock market as a business partner named Mr. Market. Every day, Mr. Market comes to you offering to buy your shares or sell his shares. But Mr. Market is extremely emotional. Some days he is optimistic and offers very high prices. Other days he becomes fearful and offers extremely low prices. The key lesson is that you should not follow Mr. Market's emotions. You should take advantage of them. When the market is overly pessimistic, it may offer opportunities to buy good companies at low prices. When the market is overly optimistic, it may be wise to sell or avoid buying. The intelligent investor uses the market as a servant, not as a guide. Lesson 3. The margin of safety. Another powerful idea in the book is the concept of margin of safety. This principle means buying investments at a price significantly lower than their actual value. This creates a cushion that protects investors if something goes wrong. Think of it like building a bridge that can hold 30 tons but only allowing vehicles weighing 10 tons to cross it. That extra capacity provides safety. In investing, this means buying stocks when they are undervalued compared to their real worth. If the company performs well, the investor profits. If the company performs worse than expected, the lower purchase price reduces potential losses. The margin of safety is one of the most important principles of value investing. Lesson 4. Defensive versus enterprising investors. Benjamin Graham divides investors into two types: defensive investors and enterprising investors. Defensive investors prefer a simple, low-effort strategy. They want steady growth without spending too much time researching stocks. Graham suggests that these investors focus on diversified portfolios, such as index funds or stable companies. Enterprising investors, on the other hand, are willing to put in more effort and research. They actively look for undervalued stocks and hidden opportunities in the market. Both approaches can work successfully. The key is understanding your own personality, time commitment, and risk tolerance. The intelligent investor chooses the strategy that fits them best. Lesson 5. The danger of market psychology. One of the biggest enemies of investors is their own emotions. When the market rises quickly, people feel greedy and buy overpriced stocks. When the market crashes, people panic and sell at the worst possible time. This emotional cycle leads many investors to buy high and sell low, exactly the opposite of what they should do. Graham emphasizes that successful investors remain calm during both market booms and crashes. Instead of reacting emotionally, they focus on long-term value. Lesson 6. The importance of diversification. Diversification means spreading investments across different companies, industries, or assets. Graham believed diversification protects investors from major losses if one investment fails. Even if some investments perform poorly, others may perform well and balance the portfolio. This strategy reduces risk while still allowing steady growth over time. For most investors, diversification is one of the simplest and most effective ways to protect wealth. Lesson 7. Long-term thinking. Another key lesson in the book is the importance of long-term thinking. The stock market moves up and down constantly. Prices may change daily based on news, emotions, or speculation. But over long periods, strong companies tend to grow and increase their value. Graham teaches investors to focus on long-term business performance rather than short-term market movements. The intelligent investor understands that patience is one of the greatest advantages in investing. Lesson 8. Avoid overpaying for growth. Many investors chase companies that are growing quickly, believing that high growth will continue forever. But Graham warns that high expectations often lead to overpriced stocks. If investors pay too much for a company, even strong growth may not lead to good returns. Instead, Graham suggests focusing on companies with reasonable prices and strong fundamentals. The intelligent investor cares not only about the company but also about the price paid for it. Lesson 9. Investing requires discipline. One of the most powerful messages of the book is that investing success depends more on behavior than intelligence. Many highly educated people fail in investing because they cannot control their emotions. Successful investors follow clear rules, stay patient, and avoid impulsive decisions. Graham believed that the biggest challenge in investing is not understanding the market, it is understanding yourself. Final lessons from the book. To summarize the wisdom of the intelligent investor, here are the key principles. Invest for the long term, not short-term speculation. Control your emotions during market ups and downs. Buy investments with a margin of safety. Focus on value rather than hype. Diversify your investments to reduce risk. Be patient and disciplined. These principles may sound simple, but following them consistently is what separates successful investors from the rest. Even though The Intelligent Investor was written more than 70 years ago, its lessons are still incredibly relevant today. Markets change, technologies evolve, and industries rise and fall, but human psychology remains the same. Fear and greed continue to drive the market, which is why Graham's principles remain timeless. If you learn to think like an intelligent investor, you won't just chase profits. You'll build lasting wealth while protecting yourself from unnecessary risk. And now I want to ask you something. If the market crashed tomorrow and stock prices dropped by 50%, would you panic and sell? Or would you see it as an opportunity to buy great companies at a discount? Think about it and share your answer in the comments. If you enjoyed this video and learned something valuable, don't forget to like the video, share it with someone who wants to learn about investing, and subscribe to the channel Money Library for more powerful book summaries and financial knowledge. Thanks for watching, and I'll see you in the next video.